Okay, student, let's start. This is second live revision class of taxation. The session is December 2024. We are studying Finance Act 2023, and don't forget the variant. Your variant is UK. Okay. Let's start, and I hope everyone is having the focus notes. If you don't have the focus notes of taxation, do ask in your WhatsApp group. Then definitely admin is going to share the notes with you. These notes, focus notes, they are more than enough. After this, there is no need. There is no need to read the Kaplan book. No need means no need. Do not waste your time. It's better to spend that time on Kaplan kit rather than spending the time on Kaplan book. Okay, let's quickly discuss few exempt income, and then obviously we'll go towards adjusted net income, property income. Types of income, exempt income. Now, students, please, for exempt income, obviously you need to memorize the list. See, the paper of taxation, actually, I would say it tests your memory skill. So you should be really good in memorizing the things. If you are really good in memorizing the things, then obviously taxation will never disturb you. Exempt income means you are getting the income, but you are not paying any tax. Exempt income means you are getting income, but you are not paying tax. Number one, interest from national saving and investment certificates. It will be categorically written in the multiple choice question that someone is getting interest from national savings and investment certificates. So if someone is getting interest from national savings, and someone is getting, let's say, interest from investment certificates, both are exempt. Gaming winning, betting, lottery, and premium bonds winning, all are exempt. Basically, in UK, this gaming, betting, all this is okay, it's legal. Even someone gets a lottery, it is again legal in UK, and it is also exempt. Scholarship paid to the taxpayer is exempt. Scholarship paid to the taxpayer is exempt, while scholarship paid to the taxpayer's family member is taxable. So scholarship paid to the taxpayer is exempt, assuming that particular individual is the one who is actually paying the tax, and that person is also getting the scholarship. So that is exempt. But if his family member is getting the scholarship, so then such a scholarship is not exempt. For example, let's say you are an employee and you have got the scholarship. For you, scholarship is exempt, but because of you assuming your family member has somehow managed to get the scholarship, so that scholarship is taxable. So scholarship paid to the taxpayer is exempt, while a scholarship paid to the taxpayer family member is taxable. Now, father is a taxpayer, and assuming father has also got the scholarship, exempt, but father's son is not a taxpayer. Let's say he has got the scholarship. Now that scholarship becomes taxable. So scholarship paid to the taxpayer family is taxable. Interest received from individual saving account is exempt. It will be categorically clearly written that individual is getting interest from ISA, from individual saving account. Simply, students, you need to memorize one point, that is interest income from ISA is exempt. Now, let me give little bit more detail on ISA. Individual saving account. Interest income from ISA is exempt. Plus, in the tax year 2023-24, individual saving account limit is 20,000. How much an individual can deposit? How much an individual can deposit in an individual saving account in the tax year 23-24? that is 20,000 pound. Okay. Next point, it is not necessary. It is not necessary to keep entire 20,000 pounds in the form of cash in individual saving account. There's a possibility that in individual saving account, this limit can be split, that some of, let's say, a portion of 20,000 someone has kept in the form of cash in ISA, and that individual has also kept shares in ISA. I'm just assuming 8,000 pounds they're deposited in the form of cash, and the remaining 12,000 that individual has bought shares, and those shares are in ISA account. So another concept is, it is not necessary that you have to keep entire 20,000 in the form of cash. It can be in the form of cash as well as shares. You can split that into any proportion. It is not necessary that 20,000 you have to split 10,000 and 10, not necessary at all. Another concept, now this is very important. We know that interest income which is coming from ISA is exempt. Interest income from individual saving account, we know that it is exempt. Now there is a possibility that individual has kept shares in ISA as well. On those shares, assuming individual has got the dividend. Now listen, dividend income which is coming from ISA, dividend income from individual saving account, it is also exempt. If this is the case, please students listen. It will be again clearly mentioned in the question that individual is getting dividend income from ISAs. You just need to memorize one point. If interest income is coming from ISA, it is exempt. If dividend income is coming from individual saving account, it is exempt. How come the dividend income comes from ISA? It is very much possible because I have already given you the concept. It is not necessary that in individual saving account, you have to keep the entire amount in the form of cash. You can keep some of the amount in the form of cash, rest you can keep in the form of shares, and you can split that 20,000 in any proportion. Third, another important point, capital gain on disposal of shares in ISA, that is also exempt. There is a possibility that after some time that individual has, let's say, sold the shares, and those shares they were in ISA account. So if examiner says interest income is coming from ISA, exempt. If examiner says dividend income is coming from ISA, exempt. If examiner says individual has sold shares, those shares they were in ISA account, exempt. Okay, now come here. State benefit paid in the event of accident, sickness, or disability is exempt. Interest on repayment of tax is exempt. What do you mean by this? There's a possibility individual has paid more tax to the HMRC. I'm just assuming. If individual has paid more tax to the HMRC, HMRC is UK Taxation Authority, okay? So let's say individual has paid more income tax, assuming in advance to HMRC. Actual liability is assuming 80,000, but individual has already paid, assuming 1,20,000. So how much individual has paid more? 40,000. Number one, that 40 will be refunded by HMRC to the individual. But the good thing is, HMRC will not only refund that 40,000, they will also pay the interest to that individual on that 40,000. Repeat, HMRC will not only return that 40,000 to the individual, they will return 40,000 plus they will also give interest to that individual. So now the interest income which individual is getting from HMRC, because individual has paid more tax, so that interest income is exempt. Okay. Employment income, we know that employment income is income, and this is not exempt. Come here, we know these things. I've discussed this. Subscription limit is 20, which can be split into shares, and look at this in any combination. 20,000 could be in any combination. It is not necessary. It has to be 10-10, not necessary. The last point is important, students. The last point of ISA is very important. Additional allowance. ISA limit of £20,000 will be extended. Additional allowance, ISA limit of 20,000 will be extended by ISA deposit balance of the deceased person. Let's say in case of husband and wife, assuming the husband is no more, I'm just assuming, and husband has already deposited, assuming 12,000 into ISA. In that case, what is the rule? Additional allowance. ISA limit of 20,000 will be extended by ISA deposit balance of deceased person. So deceased person, how much that deceased person has deposited? 12,000. Now, for wife, the limit will not be 20,000. It will be 32,000. Now, for the wife, limit will not be 20. It will become 32. Let me repeat again. Additional allowance. ISA limit of 20,000 will be extended by ISA deposit balance of the deceased person. But obviously, it is only applicable in case of husband and wife. In case of spouses, it is applicable. It is not applicable for every individual. It is only applicable in the case of couple. Income tax performer, we know that. Just one more concept of qualifying interest. Actually, qualifying interest is deducted from the total income. From where do we deduct qualifying interest? We deduct the qualifying interest from the total income. Qualifying interest is not deducted from any specific income. It is actually deducted from the total income. Interest paid on a qualifying loan is a qualifying interest. Loan is a qualifying if taken for the following purposes. It is again very necessary. Number one, you should be able to understand the qualifying interest. And the second, you should understand and try to memorize all the situations when the loan is a qualifying loan. Because obviously we have multiple choice questions as well, and you never know. Multiple choice question can come from any area of your syllabus. So basically, this is your income tax format. Qualifying purposes, number one, to purchase plant or machinery used in the business by a partner. Let's say partner has taken the loan. From that loan, partner has bought the machinery, and that machinery is used in the business. So such a loan is a qualifying loan. To invest in partnership by a partner. So first partner has taken a loan, and then that partner has invested in a partnership. Partner has taken the loan, then invested in the partnership. Again, it is a qualifying loan, and it is a qualifying purpose, and interest paid is a qualifying interest. To purchase shares in closed trading company controlled by less than equal to 5 shareholders. So examiner can ask in a multiple choice question, a very simple question. What do you mean by closed trading company? Actually, closed trading company means where control is with less than equal to 5 shareholders. Control means less than equal to 5 shareholders. They are having combined holding more than 50%. Obviously, when you have holding more than 50%, then you will get the control. So to purchase shares in closed trading company, and the company is controlled by less than equal to 5 shareholders. To purchase plant or machinery by an employee for use in the job. I have not seen such an employee, but it is possible they might be having in UK such employees. For example, now, step one, employee has taken the loan. Then employee bought, assuming a very sophisticated, advanced, expensive laptop. And now that employee is using that laptop in his or her job. So such a loan is a qualifying loan. To purchase plant or machinery, the best example in today's world, it could be, I would say, computer, laptop, in fact. To purchase shares in an employee-controlled trading company by a full-time employee. So if you are a full-time employee, what they're saying, to purchase shares in an employee-controlled trading company by a full-time employee. Number one, you are working as a full-time employee in a company, and that company is actually controlled by whom? Employee. So to buy the shares in an employee-controlled company, you have taken the loan, and that loan is all for a qualifying purpose. So please, it is highly advisable. Try to, again, I would say you need to memorize all these 5 steps. All these 5 are the examples of qualifying purposes, and interest paid on a qualifying loan is a qualifying interest, which will be deducted from the total income. Okay. Now let's discuss this with the correction. Now come here. We know that students, can I say every individual in UK is not required to pay income tax. Only those individuals are required to pay income tax in UK. Only those individuals are required to pay income tax in UK. They are having income. Can I say more than personal allowance? And the limit of the personal allowance is 12,570. So now the concept is why they have introduced this limit of 12,570. The rationale, the reasoning behind this is only one. So that those people, they are actually earning even less than 12,570, or they are earning equal to 12,570. Logically, they should not be paying tax. So basically, the introduction of personal allowance means simply to support those people, they're not earning well. If someone is already not earning a really good amount of money, so what is the point of charging the tax? Obviously, that will discourage those people. So what I personally believe, according to HMRC, but that is according to HMRC, not me. According to HMRC, I believe, just a minute, 12,570 divided by 12. Just I want to tell you one. 12,570. Please do not use any, I would say, function of Zoom. 12,570 divided by 12. We are getting 1,047.5 pound per month. What I believe, why HMRC has kept this limit of personal allowance, I think they believe whoever is earning just this much amount can only live in UK. So in order to live in UK, at least this is the lowest amount that person has to earn. But let me tell you one thing. If someone is earning this amount in our country, in Pakistan, so that person can spend a really good life. Because if you multiply this with, I would say, 360, so per month, you can see that. But in UK, so why they have kept this personal allowance limit? So what I believe, that is a calculation of HMRC, that if someone is earning, let's say, 1,047.5 per month, so logically, according to them, it is good enough to just live in UK. So that is why they come up with the solution. If you are earning more than that, pay us the tax. Now it's okay, it's totally fine, the concept of personal allowance. But there is another question also. What about those wealthy individuals? They are really rich. Obviously, if a low income person is getting benefit from the personal allowance, it is logical. Why to give the benefit to those people they are earning already a really good amount of money? So HMRC, they come up with a solution. The solution is concept of adjusted net income. According to HMRC, any individual who is having adjusted net income more than 100,000, an individual who is having adjusted net income more than 100,000, then personal allowance will reduce for that individual. Why? Actually, they have introduced the concept of adjusted net income so that simply wealthy people should not get the benefit from personal allowance. So simply HMRC come up with a solution. According to them, if someone is generating in one tax year adjusted net income more than 100,000, then personal allowance will reduce. Now we need to learn two things. How do we calculate adjusted net income? And second, what is the formula of reducing personal allowance? So let us first see the format of adjusted net income. Simply we'll take net income less gross PPC, gross personal pension contribution, less gross gift aid donation. The final answer will be adjusted net income. If adjusted net income is more than 100,000, then personal allowance will reduce. The personal allowance is 12,570 less adjusted net income minus 100,000. Into 1/2 or 50%, it's the same thing. So you can see the formula. If an individual is having adjusted net income more than 100,000, then obviously personal allowance will reduce. Now, another very important point. If adjusted net income is equal to greater than 1,25,140, if adjusted net income, any individual who is having adjusted net income equal to greater than 1,25,140, then mathematically personal allowance becomes zero. Obviously, it cannot be negative. Mathematically, of course, if your answer of adjusted net income is more than 1,25,140, then obviously mathematically your answer is going to be negative if you deduct from 12570. But either personal allowance is going to be positive or zero. It cannot be negative. For example, personal allowance is 12,570, assuming adjusted, I'm just assuming adjusted net income is 1,50,000. Obviously, minus 100,000, 1/2. So it's going to be 25. So instead of 25, just write 12,570. I cannot minus 25. Even you want to minus 25, then again, this is also acceptable. Another presentation is also acceptable. Someone has written 12,570, then do deduct 25. Then please write 0 and explain the examiner why 0. Simply you explain the examiner personal allowance cannot be negative. So that is why mathematically, any individual who is having adjusted net income either 1,25,140 or more than that, then simply personal allowance becomes 0. Now, personal pension contribution. Actually, personal pension contribution means, let's say someone has taken the insurance policy. If someone has taken the insurance policy, HMRC, they do encourage that people, they should take insurance policies. What are the tax implications of personal pension contribution? So let me explain that. Number one, whatever individual is paying, it is 80%, 20% is paid by HMRC. Second, gross PPC reduces adjusted net income. Third, gross PPC increases basic and higher rate band. Increases basic and higher rate bands. And in exam students, nothing is mentioned. We will always assume given PPC is net, it is 80%. How do we gross? Nothing is mentioned. Take the PPC amount 100 upon 80. So we know that basic rate band is 37,700. Simply we'll add gross PPC. High rate 1,25,140, but simply add gross PPC. So your limits of basic rate band and high rate band will increase. These are the tax implications. Now, very important concept. Tax implications means tax consequences. Now, listen, please carefully, students. Personal pension contribution payment is not your expense. Personal pension contribution is not an expense of the individual. You cannot deduct from your any income. You might be thinking, sir, there's a cash outflow. I know that. But taxation authorities, they are giving you the benefit. Look at this, the benefit. One, gross PPC reduces your ANI. Your basic and high rate band both will increase by gross PPC. So ultimately, you are going to save the tax. So obviously, they cannot allow you take PPC also as an expense. Then obviously, there will be double tax savings. One, if it is treated as an expense, you will save the tax because expenses, what do? They reduce your income. So once you have reduced your income, second, let's say HMRC has also increased your basic and high rate band. So then HMRC will be at loss. So the rule is payment to the personal pension contribution is not an expense. Okay. Now another point, gift aid donation. Gift aid donation is having the exactly same tax implications. Gross, I would say again, gift aid donation is exactly the same like PPC. Number one, gifted donation is written, nothing is mentioned, it is always net. You have to gross it up. Second, 20% will be paid by HMRC, whatever individual has paid, it is 80%. Basic and high rate band will increase by gross gifted donation. So it is not only the gross PPC, it is also the gross gift aid donation. So gross gifted donation also. So you just need to remember one point, that tax implications of PPC and gifted donation exactly same. And nothing is mentioned, gifted donation is 80%, you have to gross up. How do we gross? 100 upon 80. Okay. We have discussed. Now another concept, transferable amount of personal allowance or marriage allowance. Now, what do you mean by this marriage allowance? For marriage allowance, okay, students, number one, please, I have explained this area already very well. So please do not, I would say there's no need to spend time on this grid, which I have given you in the notes. Otherwise, you will get confused. Already, how do we apply starting rate band for the saving income? We have already discussed. How do we calculate tax? First, we go for non-saving, then saving, the last dividend income. This is already done. So that is why I'm saying, please do not spend time on this. Otherwise, for no reason, you will get confused. It's better what we have already discussed in the revision and in our regular classes, just focus on that. Okay, now. Question. Okay, please ask. There's a question. Let's wait. Yes, starting rate band is 5 maximum, obviously. It's not more than 5. And when it is applicable, we have discussed yesterday also. Starting rate band is maximum 5,000 and it is only for the saving income. No, no. Can anyone explain when starting rate band comes into action? Have you? I think you have taken yesterday class as well. Okay, let's say individual is having a saving income 5,000 and the same individual is having non-saving income. When non-saving income is, yes, this is the concept. Please. When actually taxable, I think Mohammed Saleh, have you taken yesterday class? Yes or no? I think we did discuss. So I think we did discuss this point, if I'm not wrong, that if your taxable income in the column of non-saving is 1,000, you will get 4,000 saving income. If it is 2, you will get 3. I think we made that list as well. But I hope now it is clear. Okay. Marriage allowance, come here. Marriage allowance, if both spouses, husband and wife, are basic rate taxpayers, then they can transfer personal allowance 1260. How much they can transfer? 1260 to each other. That is called marriage allowance. Spouse civil partners receiving the marriage allowance do not have to, what they're saying, you will not increase the personal allowance. Simply instead, income tax liability will be reduced by 252. And this last point is very important for a multiple choice question. If income tax liability is less than 252, then it cannot create a repayment. Now come here. Assuming husband, wife, let's say husband is having employment income. Assuming husband is having employment income 7,000. And let's assume wife is having employment income 20,000. We are required to calculate income tax liability for wife. Income tax liability. And we need to calculate income tax liability for wife. Obviously, husband will not be paying the tax. Look at the income is less than personal allowance. Now listen carefully. Number one, both are obviously basic rate taxpayer. Plus, husband does not have the enough income to utilize the entire personal allowance. Husband does not have the enough income to utilize the entire personal allowance. So obviously, it is highly advisable that husband should transfer 1260 to his wife, provided that they should be obviously at very good terms. There shouldn't be any fight between husband and wife. Normally, I would say husband and wife, they keep fighting. So in that case, there's a possibility husband can say that I don't want to transfer my personal allowance to you. Uh, Otherwise, obviously, if everything is okay, so husband is willing, should be happily transfer the personal allowance. In this way, tax will be saved. Let's see. Wife is having income 20,000. Employment income, okay. Personal allowance is 12,570. 20,000 minus 12,570. Taxable income is 7,430. Obviously, entire 7,430 applicable tax rate is 20%. I'm getting 1,486. Now, less the marriage allowance relief, less marriage allowance relief. That is fixed 1,260 into 20%. 252. So 1234. So income tax liability is 1234. Now you need to learn one more thing here. Husband, wife. Assuming wife is having employment income, let's say 18,000. Okay. And let's assume husband is having employment income 12,000. Okay. Husband is having employment income 12. Wife is having employment income 18,000. Again, it can be clearly seen that husband cannot utilize the entire personal allowance. Now, what is not permissible? Please look at this. If husband says, I'll deduct personal allowance 12,000 and 570 I will transfer, it is not permissible. If you want to transfer, then you have to exactly transfer 1260. You cannot transfer the personal allowance less than 1260 and you cannot transfer more than 1260. Now let's calculate income tax liability for both husband and wife. Now listen, personal allowance is 12,570. From this 1260 will be deducted because of the marriage allowance. So 12,570 minus 1260. Now husband will be getting the personal allowance 11,310. Obviously, wife will get 12,570. Husband 12,000 minus 11,310. I'm getting 690. 18,000 minus 12,570. I'm getting 5,430. Obviously, husband into 690 into 20%. Income tax liability is very simple. 138. Wife 5430 and then 20%. I'm getting 1086. But from this 1086, we will deduct marriage allowance relief less marriage allowance relief, which is 1260 into 20%. 252. $834. I hope now marriage allowance concept, obviously you have already, I hope already you have seen the video, but now it should be very, very clear. Marriage allowance. This is, we already know that, so there's no need to read, otherwise you will just get confused. Donation, obviously gross gifted donation, there is no limit. As much as you want, you can contribute. Individual can donate any amount, so there is no maximum limit for donations. There are two types of donation. Donation under payroll deduction scheme. For this student, please just you need to know only one point. These will be paid gross and deducted from employment income, and it will come in the employment income as well. But just remember one point. If your examiner says donation under payroll deduction scheme, that amount is already a gross amount. Second, that amount will be deducted from the employment income. Basically, what happens? UK is UK. If you're working in UK, so you will be paying certain donation, either happily or unhappily. Logically, what happens when you are working in UK and when you will be getting your check, when you will be getting your salary. So normally you will get the salary after the deduction of this payroll scheme. So basically in the exam, you just need to know one thing. If examiner says there's a Mr. XYZ is having a donation under a payroll deduction scheme, And that's an employment income question. Students, you just need to do one thing. Simply deduct that donation from the employment income. Simply deduct that donation. Which donation? Donation under payroll deduction scheme. That will be simply deducted from the employment income. Donation under gift aid we have discussed, because donation under gift aid scheme has the same implications like PPC. Okay, taxation of a spouse family, simply jointly on asset. If there is any jointly on asset between husband and wife, so income will be split 50-50. If there is a jointly owned asset between husband and wife, if there's a jointly owned asset between husband and wife, so that income will be split 50-50 irrespective of their actual ownership percentage. But if both of them, if they want that income from the jointly owned assets should be split according to the proportion of ownership, so it can be done, but it can only be done when both husband and wife both go together to HMRC and they make the joint election and they declared in front of HMRC what is their actual proportion of ownership. Once both have visited to HMRC and both have declared the actual proportion of the ownership of the jointly owned asset, then income will be split according to their actual ownership. So repeat, if there is a jointly owned asset between husband and wife, nothing is mentioned, income will be split half-half. However, it says election is available for actual proportion of income to be assessed on each partner by declaration. When it comes to declaration, they both have to declare. All children are taxable person required to pay income tax if their income is what? More than personal allowance. Okay, students. Now let's go towards property income. Actually, I did mention that we are going to discuss property income today, but now I deliberately don't want to discuss this today. There's a reason behind that. Because some of the students, they have joined today and there are a number of students, they are alhamdulillah joining us. So I want them to, just watch few videos so that we all can revise the property income together. So I hope students, again, today's class, you should have enjoyed. So that is why I just want to delay the revision of property income. So inshallah, in the next week, we'll be revising it around 2 chapters. One is going to be the property income and then either half or if possible, then more than half of employment income as well. But please, students, keep watching, I would say, your pre-recorded regular lectures. And again, it's a request, do not miss live revision classes. See, during live revision classes or through live revision classes, I'm going to discuss the entire taxation course. Entire taxation means entire taxation. You might have noticed within these 2 classes, we have covered number of areas. You can just check. Plus, you might have noticed the speed of the live revision classes is not fast at all. In fact, I would say it's more or less like a regular class, or maybe I don't think we are going very fast. The speed you can see is, I would say, appropriate. So just because of that, student, I don't want to go for the revision of property income today. So simply thank you very much. Do give the feedback of today's class as well. It motivates the tutor and other students as well. So thank you very much. It's my commitment to give you the revision of entire taxation through live revision classes. And we are not only doing in taxation, we are doing in almost in every paper. So either it is I would say PM, FR, SBR, ATX, AFM, FM, every paper. So I hope if you are attending all the revision classes, so live revision classes, they are difference making. So thank you very much, students. Stay in touch. Do give the feedback of today's class as well. Thank you.